now that we've gone over what you can trade and how you can trade it, we can start to dive into the fun part, which is actually determining when to buy and sell. Day traders do not care about where the market is going to be in a month or in a week from now, and they're only concerned with intraday price action. Thus, most of the analysts, when it comes to buying and selling, is done using technical analysis. Technical analysis refers to the analysis of price charts to determine common patterns and themes, and the analysts assume that these patterns repeat themselves and this can be used to determine buy and sell points. In this video, I'll be going over the absolute basics in technical analysis, going over price charts, candlesticks, and other common concepts. The world of technical analysis is vast, and there are several thousands of indicators the analysts have developed, each with their own unique strategies. And after this video, I'll be going over the algo snipe trading strategy and the indicators that you will see in the live charts that we show you Monday to Friday. Just a quick tip before we begin. If you ever do come by a new technical analysis concept or a strategy, it is always important to backtest and paper trade the strategy before implementing real funds to ensure that the strategy matches with your trading style. As always, guys, I just want to give a quick disclaimer that everything that I talk about in this video, plus all the material provided on Discord and in the trading room, is for educational purposes only. Nothing should be considered financial advice. Also, make sure you guys are aware of the risks when it comes to trading in financial markets, especially when it comes to trading highly volatile and leveraged assets like futures and options. With trading, you have the ability to earn high returns, but there is also high level of risk, and you can blow your account. So please make sure you guys are aware of that, and please do your own due diligence. Alright, so now that's out of the way. When starting off with technical analysis, the first thing that we have to go over is the price chart. There are several different types of charts that relay different types of information. There are line charts, bar charts, spot and dot charts, candlestick charts, Fibonacci charts, and etc. But the one that we like to use, and probably the one that's most commonly used, are candlestick charts because they provide the most amount of information, right? So in front of you here, you can see that this is an example of a candlestick chart. Every price chart can be pulled up again by its stock ticker symbol, which is a 4-letter symbol that is used to represent the stock. So in the previous video, we talked about a ticker symbol. So for this particular example, I'm using the ES, which is S&P 500 futures, and I'm using the March 2024 expiry. Every price chart is defined by its, on the bottom axis you can see its time, and on the right axis you have its price. Okay, so every price chart has its price and its time. Candlestick charts provide the most amount of information because each candlestick on the chart represents data from a moment in time. On this daily chart, you can see that each candle represents one day. So if we zoom into one candlestick here, for example this one here, you can see that this candlestick represents the entire action for this S&P 500 futures contract for Wednesday, December 13th. The body of the candlestick represents its open and close. So for this green candlestick, we had the opening price at 46.99.50. So opening was 4,700. Then we had the closing above here, which was at 47.60. All right. So when you have a green bodied candlestick, that means that price went up in that time frame. When you have a red bodied candlestick, that means price had gone down in that time frame. So in this time frame, so on this December 20th candle, price had opened up here around 48.18, and then it closed down here at 47.48. So on this day, December 20th, price had gone down, right? The wicks on the candlesticks represents the highs and lows during that time frame. So if we look at this candlestick from December 14th, we can see that it opened at 47.61, it closed at 47.74, it reached a high during that time at 47.93, and it had a low of 47.48. Okay. It is common for technical analysis to use a combination of these candlesticks to form what's called candlestick patterns to indicate any reversals or continuation in price. Sometimes when you see, for example, like three strong green candlesticks to the upside, it can indicate that that there might be more buying pressure and that the trend can continue up. Sometimes you might see the indecision candles like these, which can indicate reversals. For most of the common candlestick patterns and like all the candlesticks to look for, if you guys look at the education channel in the Discord, you will see a candlestick cheat sheet, which will have a quick breakdown of the most common types of candlestick patterns that are used. Okay, so essentially with candlesticks, to break it down, there's pretty much two common types of candlesticks that you want to look out for. There's the high conviction candle and there's the indecision candle. In the high conviction candles, you would have a big body, and that represents a high conviction in the direction of the trend. So if you see a big body green candle, then that's a high conviction to the upside that prices might continue to move higher. If you see a big bodied red candle, that's high conviction to the downside and might indicate that price might move down further. Indecision candles usually have small bodies and big wicks. This can indicate that during that time frame that there was no control, that price didn't go higher, price didn't go lower, so therefore there's no control between buyers and sellers, and it can lead to this indecision, which can indicate possible reversals in trend. So the first way to analyze price charts is to basically just read the price action and read candlestick patterns as they come up. The next way that you can analyze price charts is by determining areas of support and resistance. Support is an area below the current price at which price has bounced off of to the upside several times. Resistance is an area above price at which price has bounced down from several times. So using price charts, we can identify also trends in price. So we look at price over times, and when we make higher highs and higher lows, connected can form an uptrend in price. And when you see lower highs and lower lows, this can form a downtrend in price. These areas can be identified as important areas on price, as they can either trigger a break or a rejection and help determine intraday trading. Alright, so if you go back to the example with the charts, so here we have the ES on the daily chart. So common areas, so currently the price had closed on Friday, December 29th. It had closed at 48.20. So a common area that we can look for under this as area support would be for where price had bounced off of. So if we look down here, we see that price had came down into this area, rejected, and moved up. This seems to be a common area that price bounced off of, because it also bounced off of it on December 14th, then again on December 20th, and then again on December 21st. So we can mark that as the area, and this level 47.51 would be our support zone. So essentially what we're waiting for now is for price to come back to this area to either support a bounce off of it or a break down below. How we determine more on the common, like on the short time frames, if to buy and sell, is based on the algo snipe trading strategy, which I will explain in video 5. Alright, so another way to, so this would be a common area of support. On the opposite end, to look for resistance, you look for an area above the current price where price has bounced down from. So in this case, market is now making 52-week highs, so there isn't really a strong area of resistance to look for on the daily charts. But let's zoom in onto the hourly. So if we look into the hourly chart, we see here now that price is able to come up and bounce from this area several times before getting rejected. It came up here, bounced down, got rejected. Came up here, bounced down, came up here, bounced down, came up here, bounced down. So we've seen that this is a common area where price is coming up, down, and getting rejected from, and it's above the current price, so that could be labeled as our resistance. So this will be 48.29. So now what we're looking for is for price to come back up into this area and to see if it either it can either push up or if it's going to get rejected again like it has in the past. So this is one way that analysts use to determine price charts, and key areas on the key areas to determine when to enter and exit is to identify these important levels of support and resistance. Another key way to study market is to understand its trend. So some markets operate in essentially two modes. They either can be the first mode can be seen as consolidation or accumulation, where you see price move in a tight range. During this time, markets can be building momentum before the next trend. All right. So if you look at this example on this chart here, so essentially we see that right here. So in this area, I'm just going to highlight it with the rectangle. So in this area, you can see that price had moved sideways, forming this consolidated type range, right? And then once it broke out of that range, it operated into the second mode of markets, which is called the trend mode. So higher trends can be identified by areas where there's higher lows and higher highs. So looking here, you see that price made a low here, then it made a higher low here, then it made a higher low here. So if we simply just take a line and connect those, we can see that currently price is uptrending, right? So price is constantly moving higher, bouncing off of this trend line several times. Now this could also be an important area to mark, because if this trend line now breaks, it can show a change of character, which means that the uptrend is now coming to an end, which can potentially signal a potential reversal in the markets. Okay, so it's important to identify when the market is either operating in this choppy consolidation mode, or if it's operating in a trend mode to the upside. All right. Another key important concept that can be used to determine important levels on the price chart is to determine demand and supply zones. So demand and supply zones are areas on the chart where you can see actual institutional buying come in that can push price move to the upside or the downside. How you determine the demand and supply zones is from a concept called order block theory. Order block theory was not developed by me. It's part of a concept called inner circle theory that you can find on YouTube. I don't use all of inner circle theory's concepts, and a lot of his concepts are heavily scrutinized in social media, by social media and on financial Twitter. However, this order block theory is, I've seen it work in the past, and I will show you guys how exactly I use it. So essentially, I use it to determine key areas of support and resistance on the chart by looking for areas that have what I call imbalances, right? And imbalances are areas in the price where you see giant swings in price, which causes a huge body and no wick movement. So one example you can see here is that on Wednesday, December 20th, we had a big move down in price, right? So we had a big move down, and this caused this huge body candle to move, and there's no wicks in between. So this is what you call an imbalance, right? So because we had big selling come in, this is what I would call a supply zone, right? I will mark the beginning candle that initiated the move. I will mark the opening of that candle, right? And I will label that as what I call a supply zone. So I'll put that as a supply zone. I'm just going to remove this one here for now, right? And then I'll make a rectangle from the opening, so where I determine the point of interest for the supply zone, and I'll put a rectangle to the highest wick of either the initiating candle or the candle that started the imbalance, right? And then that would be my supply zone area. So now this would be a point area that I'll be watching, similar to how I watch my support and my resistance. This will be a key resistance area that I'll be watching on the market, because at this point, a lot of selling had come in that had caused a significant move down in price. So that's a supply zone. Let's see if I can find a demand example here. So there's one right here actually. So we had a big move up in price, caused a little imbalance, right? So I'll mark the opening of that candle as my point of interest. I'll label that as the demand zone. That'll be my demand zone, and I will set a rectangle from the opening to either the lowest of the wick of the initiating candle or the starting candle, and I'll put that in. And that'll be sort of my support area. So this is just one way on which you can analyze price charts, is by analyzing these key areas of support and resistance, and then reading the price action and looking at the candlestick patterns that when price gets there to determine if it could be an area of you entry or exit. Again, guys, this is a very complicated concept, and it can be confusing for new traders, and it is just something that you will have to learn and practice before you actually start getting good at it, which is why I always recommend backtesting and also paper trading before actually using any real funds. Okay, another important concept. So we already talked about the two different types of modes that the market can be in. Mode one is just chop, which is sideways accumulation, and the stock is just building momentum for the next trend. Mode 2 is it's either moving in an uptrend or it's a downtrending market, and you can see a clear direction by higher highs or lower highs. Another very important concept is higher time frame analysis. So it's important to note that support and resistance levels that hold higher significance on longer time frames, since they encompass more data. So when you see a support and resistance level on like the hourly and the daily charts, it can be a stronger level to point out than a support and resistance, let's say on like the 5-minute chart. As day traders, we primarily use the hourly and the daily charts to determine the longer term trend, and then we use the shorter time frames like the 5 minute and the 1 minute to time our entries and our exits. It's also important to note that a big part of technical analysis is pattern-based trading, which essentially means that the technical analysis will look at price charts to identify common patterns and will take trades on the assumptions that these patterns will repeat themselves. There are patterns based on using a combination of candlesticks, and there are also technical chart patterns that can be used by combining trend line support and resistance levels. These patterns have been put on a cheat sheet and are available for you in the education channel of the Discord. It's best to identify these patterns though in real time to see exactly how they work, but some of the common ones are listed on that cheat sheet, and you can also do some independent research if you are interested in them, or if you combine any patterns in like on your online research, you can always DM me about them as well. Along with price action and pattern identification, technical analysis also use volume and momentum to help determine the strength of trades. Volume represents the total number of trades that have been executed in that time frame. So if you see volume is increasing in the direction of the trend, then it shows strength that the price will continue to move in that direction. If volume is decreasing, then it can indicate that that trend is coming to an end and that price has the potential for reversing. Momentum does the same thing. There are several different types of indicators that one can use to identify momentum. The one that we use on our price charts is called TTM squeeze. I will talk more about this in the next video when I break down the algo snipe trading strategy. Okay. When it comes to technical analysis, guys, the world is vast and there is a lot of different studies that analysts use to study previous market data to form their future predictions of price movement. So I don't want to go through every indicator in this video because I feel like if I did, this video would be 10 hours. But if there is one that you come across, or if there's one that you need help understanding, always feel free to DM me at any time. The indicators that we use and what you see on the live charts, I will go over more detail in the next video.